Hello and welcome to the Cube Talk Show. My name is Joe Barbieri, I'm your host, and this is a show about money, all different topics regarding money. Tonight we have one guest. His name is Jain. He is a financial consultant and the owner of the company Money Life Skills, and the topic will be the high cost of uninformed investing. So Neil, how are you?
I'm doing great. Thanks, Joe, for having me on.
Well, thanks for coming. To start with, tell me about your background and your company and how you do what you do.
Sure. So I run a business called Money Life Skills. It's a financial consulting firm, and I'm a fee-only financial advisor. So essentially I provide advice to people on financial decisions, and I don't sell any financial products. So I'm sure you're familiar with this type of advisor, not as common in Canada, but I think gaining importance now that more and more people are hearing about different types of advisors and about fees and so on. So that's my focus. I'm based in Toronto, so most of my clients are in Toronto and the GTA, I would say. And I've been doing this now I've had Money Life Skills now for just under a couple of years, so still relatively new, but building up a clientele in Toronto and having a lot of fun doing it.
Yeah, that's good.
Yeah.
So I think you've already touched on this, but if you could describe how are you different from the usual advisor at the bank, at the fund company, or at the institution? I guess there's different institutions.
Yeah, so for most Canadians, what they're used to is walking into a bank or walking into an investment advisor to be sold financial products. So the advice or the person that they're speaking to in terms of the financial professional is selling them a financial product and giving them advice at the same time. So the way I differ is that I provide only the advice, and I provide guidance on how to set up the right portfolio if they're looking for investments, or helping them out with things like budgeting and cash flow that you wouldn't otherwise get walking into a bank or investment company, because they're very focused on specific products, so investments, mortgages, loans, lines of credit, etc. So I have the advantage of looking at it from a broader perspective, more holistic perspective, and providing advice that's relevant to them at that time. So as an example, if someone is has a lot of credit card debt, they have $10,000 worth of credit card debt, if they're going to walk into a bank, the bank's not going to say pay down that debt. They're going to say, you haven't used your TFSA room or RSP room, let's contribute some money into that account. Whereas I can look at it more holistically and say, it doesn't make sense to invest at this time. It makes sense to pay down that credit card debt first, build an emergency fund, for example, and then think about investing. So for a lot of people, investing may not be the first priority, whereas when you walk into a financial institution, the priority is selling those financial products. So I guess that's kind of the main distinction in terms of being able to provide advice from a more holistic perspective than strictly selling products.
So in terms of how you're compensated, so it's by the time or by the work?
Yeah, so I charge a flat fee. Someone is interested in a consultation. I call it a private consultation. So I charge a fee for that consultation. And people can choose to, come back for follow-up sessions if they need it. Some people just want the advice, they want the recommendations, and they'll go on and take action. And that's part of what we do, is try to empower people to, get started in terms of taking action and making a difference in their financial lives. And some people want a follow-up 3 months or 6 months later to say, just like a checkup with the doctor, to say,
Yeah.
Am I doing things right? Am I, if it's budgeting, am I allocating my expenses properly? If it's investing, have I set up my investment portfolio the right way that it should be for me? So flat fee for the consultations and for the consultation and for the follow-up sessions.
So do you ever get people asking about, say, like the Eurozone? Do I change anything because the euro tanked, or because such and such happen around the world, and
absolutely. I mean, we live in such a media-rich world that information comes to us so quickly, whether it's local or whether it's national or whether it's global. So we know about what's going on in Europe so quickly in Canada, and so we think that we need to do something as a result of what's happening in Europe or in other countries in the U.S., especially because we're a big trading partner with them. So I do get that question a lot, and I think what I'd like to do is step back and say, okay, yeah, there's this news about Europe or the U.S., but do you have any credit card debt? Like, that might be your first priority. Or do you have an emergency fund? Or have you figured out ways of earning more income, perhaps? Those things may be more important than tweaking my portfolio to, say, pull everything out of Europe. So that's one part of the answer. I think the second part of the answer is that we've had an inordinate number of crises going back into history. So if you look back 20, 50, 100 years, we've had many different recessions, and we've had the Great Depression, and we had the Great Recession, and we had the Asian crisis, and we had now we have the European scenario. So we've been through, as a world, we've been through many different crises of sorts, and I think the people that came out ahead didn't pay too much attention to those crises, unless it was affecting them personally, which is a completely different matter. But from an investing perspective, I think the people that come out ahead simply ride out those waves and just stay invested for the long term, for 10, 20, 30, 40 years, depending on what your time horizon is and what the purpose of your money is. And I know you've written a lot about Europe and so on, so you probably know more about what's going on than me. I like to focus on an individual level. How does it really affect my investment portfolio if I'm focused on long-term investing? And the answer, I think, is not much. I mean, you have a strategy, you have a plan, and you stick with it regardless of what's going on in the world.
So how much of what you're doing is educational? It sounds like it's quite a bit, like as well as the planning part.
Yeah, I think it's a really good question. Like, what I've noticed over the last couple of years is that education is so much more important than the actual mechanics of an investment portfolio, for example, or what percentage of income are you spending towards housing costs or whatever. If you're 1 or 2% above what the guideline is, maybe it's not a big deal. I think more importantly, as you mentioned, the educational component of when does it make sense to buy a home? How much does it make sense to save for kids' education? How much should I be socking away for retirement? Like, those kinds of educational aspects about money and about investing, I think, are important to learn, and to learn them as soon as possible in life, because we don't learn them in school. and I think I mentioned before as well, like, if you grew up in a fiscally responsible family, that's pretty good, but odds are maybe not. Maybe your parents had the same trouble in terms of budgeting and debt and all those kinds of things. So it's good to get those skills as early as possible. And most of my clients, I would say, are younger. So I've had clients in their 20-somethings and 30-somethings as well. And I think it makes a big difference if you're able to get that educational aspect up front, because it saves you a lot of grief in the future. So one thing that we were talking about just before we went on is mutual fund fees, and some people think that they don't pay any fees, and so just being knowledgeable about how much you're paying in fees and how that affects your long-term investments, how much that diminishes your investments over time, I think is important to know. So I guess to answer your question, educational component of what I do has become very significant. So, greater than 50%, I would say, if I were to put a number on it.
Yeah. So, speaking of fees, I have your article here. It's called "The High Cost of Uninformed Investing and the Value of Truly Unbiased Advice." So the fee element is part of it, and Well, it talks about mortgage interest as well, conflicts of interest.
Sure, yeah.
If you want to talk more about it.
Yeah, I don't do a lot of writing, incidentally. I'm not a big blogger or tweeter. I do write occasionally, and sometimes I write for other publications. And so this is one of those articles that I wrote, and it's called The High Cost of Uninformed Investing and the Value of Truly Unbiased Advice. So I wrote this article for Toronto Manager magazine, and I talk about, focused in on mutual funds, essentially. So on an average, $200,000 portfolio, on average, you're paying $4,820 in fees. And the numbers probably changed since, this was published. You can round it up to, say, $5,000 in fees per year on a $200,000 portfolio. And I make the case that most people don't know about it. Mm-hmm. And the reason for that, the reason why I called fees the silent killer, mm-hmm. is because when you pop open your investment statement, whether it's online or printed, the likelihood of there being a number in dollars and cents that says you paid X dollars in fees this quarter is very low. There are very few companies that do this. And it's too bad that it's not regulated, that companies must provide this information. But if you were to, someone has commented about this before, if you were to physically write a check for that amount, for $5,000, you'd actually think twice before doing it. Whereas with mutual funds, and the reason I call it, uninformed investing is because you don't even know that those fees are being deducted on a daily basis in most cases from those mutual funds. And it's a very high cost because 2.5% or 2.4% may not sound like a lot, but over time it can equate to a lot of money, especially over the long term. So as an example, if I can quote from my article here, I gave an example of a $200,000 balanced mutual fund portfolio, and you don't touch it for 20 years, and you earn a 7% return annually. So those are some assumptions that I made. And your portfolio would have grown to about $774,000. Now, if you paid that 2.41% in fees on average, then that reduces your nest egg to $490,000. So that's $283,000 you've paid in fees over a 20-year period, which is very significant, which has a significant impact to what you come out with in the end. So that essentially was the gist of the high cost of uninformed investing. I think the takeaway was ask your bank or your financial advisor what did I pay in fees last quarter, because you probably won't see it on a statement, and get an answer. Like it would be interesting for you to know what you paid in dollars and cents, rather than being waved off and saying, oh, it's probably about 2 or 3%. Don't worry about it. Like over the long term, it doesn't matter. But it makes a huge difference, right? It comes down to just mathematics of how much is being chipped away from your investment portfolio.
So the other big topic is, well, actually, you mentioned that at the beginning, the conflict of interest. So selling product versus pure advice. So how, well, I think it's probably going to be an obvious answer, but how important is that, and how prevalent is it that there is a conflict? And even though they say, well, we're doing this for your interest because that's our job, how much of that is really true as an estimate? Yeah,
I think so. Going back to the article, what I talk about in there essentially is the conflict of interest that we mentioned earlier, and the reason why that exists, because financial professionals that provide advice that sell products at the same time, they're trying to satisfy multiple interests. They're trying to satisfy the client's interest. They're trying to satisfy the firm's interest that they work for. They're trying to satisfy their own interest in terms of commissions and bonuses, etc., and their shareholders' interests for that firm. So in that category of interests, of 4 different interests, you can guess where the client's interest falls. It falls to the bottom in most cases because firm comes first, because if you don't perform, then you're not going to last very long as an advisor or investment advisor at that firm. And your own interest as well as an advisor, because you want to do as well as you can and be compensated as well as you can. So what that leads to is advisors recommending products that are often too costly for the average client, and that's why the mutual funds that are very popular with Canadians, if you look at it, most people's portfolios, if they haven't paid attention to fees, then a lot of them are paying 2.5%, 3% in fees on those funds. And so I make the case for it's good to get unbiased advice from someone who doesn't have an interest in selling you those products. And so therefore you can make a more informed decision, a better decision on what type of investments you should have in your portfolio. Ideally low cost, tax efficient investments that are built for the long term as opposed to short term speculation. So I think the final point I would make on that is that there are certain things that you can control and there are certain things that you cannot control. And knowing what you can control in terms of fees, in terms of being tax efficient with investments, in terms of choosing the right investments, in terms of choosing the right investments in the sense of weighting of stocks and bonds and your risk tolerance and all that kind of stuff, you can control. You cannot control what a stock's price is going to be the next day. You cannot control the markets, and so that's essentially the focus is focus on what you can control, look for unbiased advice, and keep those fees down. So
yeah, it's very good.
Yeah.
Speaking of control, so this is another aspect of investing that I think is becoming more and more important. How much control do you have? Mm-hmm. And yeah, the markets are volatile and news happens, but but there's the other part of it, that what product do I choose? Who do I choose it with? Mm-hmm. How much research do I do myself? How much do I give to somebody else? So how important is that? If you had someone in front of you now, mm-hmm. and you were advising them, how much of that is a factor in terms of what you tell them, what you don't tell them?
I think it's a really good question, and the reason I think so is because money is so personal to each individual. So you and I, work in the industry, and so we have an interest in learning a lot about, what's going on in markets and what's going on in different aspects of the financial industry. But for the average Canadian, even if they work in financial services, I've had clients that work for banks, don't have the inclination or the desire to become experts at investing, because it can be complex in the sense of what investments do I choose, how do I make it tax efficient, how do I adjust based on changes in my life, if I get married, what do I do? So it's always good to enlist the help of a professional to the extent that you feel that it's necessary. And the reason why I think my program in terms of consultations works is because it's modular. So someone could simply take a one-time consultation and get all the knowledge and advice and counsel and recommendations that they want and run with it. And some people want to come back because they need a little bit of hand-holding or check-up to make sure that they're doing things right. So I think it really depends on each individual. Mm-hmm. I do a bit of a phone conversation, a questionnaire, sometimes an email exchange to really get to know someone better before we actually physically meet in person for the consultation, because I find that once I know what their knowledge level is, once I know what their interest level is, then I can customize what it is that I'm saying and how I speak, even in terms of what language I would use. Not English or French, but in terms of the financial astuteness level that I should be at, because some people will understand DRIPs, dividend reinvestment plans. Some people don't understand what TFSAs are. So I need to be constantly understanding my client and knowing what level I should be speaking at, so that I'm able to provide them the best advice. So it really comes down to the individual client, is what I'm saying, I guess.
Yes, mm-hmm. That's right. So we can take a break for a few minutes.
Okay.
And we'll be back. We'll be back in about 5 minutes. And we're back with the Cube Talk Show, and we're here with Neil Jain, financial consultant and owner of Money
Life Skills.
Money Life Skills. And I lost that for a minute.
That's okay.
So continuing on with the conversation about financial planning, if you get somebody who wants to buy a product, so they want to buy whatever, a mutual fund, an insurance product, whatever's out there, what do you tell them? Or how do you deal with that?
Yeah, it's a good question. I think one of the first things right up front when I have a conversation, usually the first connection with any client or potential client is over the phone. And when I talk to them on the phone, one of the first things that we talk about is that, I don't sell financial products, I only provide advice. You may not be used to this. Let me explain, how it works and people get it. And then if they feel comfortable, then, we'll move forward. And I think most clients appreciate that kind of different approach, and then they can go out and make their own, transactions in terms of the specific financial products. So I do get the question in terms of, do you sell mutual funds, or do you sell insurance, or do you sell mortgages? And the answer is simply, advice only, and it's something that I clarify right up front, because it's not something that the average client is used to. They're used to, getting advice and products at the same time.
So do they ever ask you how to navigate all that, or what to ask people, or if I go to a mortgage broker, so if I'm the client and I say, if I go to this mortgage broker, what do I do? Because am I going to get taken? Am I going to get ripped off? Is there something you offer for that, or is it more?
Yeah. So in the consultation, so depending on the specific need of the client. So let's take mortgage situation. So I had a client recently who was deciding whether to buy a home, and so I'd walk her through the entire process of getting pre-approved, knowing how much you can afford in terms of a home, knowing how much you should save and when would be the right time to make that purchase, understanding the total cost involved in a home purchase decision, because it's not simply a rent versus mortgage calculation. Yes. It's understanding the total cost of property taxes and hydro and a number of other things that go into the total cost of ownership. So I'd walk them through that process, and also how to navigate what types of professionals are there in the industry. So, should I go to a mortgage broker? Should I go to my bank that I have a relationship with? Should I search online for mortgage rates? So those types of questions I can help people navigate through depending on their specific situation. So certainly people are looking for, people want to feel more confident about their financial situation and about dealing with financial professionals, whether it's at a bank or at a mortgage broker. They want to feel like they're asking the right questions, and I think we really arm them with the confidence to be able to ask those right questions so that they can make a good decision for themselves.
Yes. So is there any area you don't cover? Like, for example, debt. Mm-hmm. Well, debt is a pretty big area, but investments, insurance.
I think it's interesting, of course, focused only on advice, but there's certain, segments of people that we don't deal with. So people that are deeply in credit card debt, for example, $10, $20, $25, $30,000 in credit card debt, it doesn't make sense because I can't help them much. And so there are counseling agencies available for that throughout Canada. Where people can walk in and get a consultation and get advice on how to pay down that debt through various different options. If it's smaller amounts, and if it's more of a they're looking for more holistic advice on how to be responsible with saving and budgeting and all that kind of thing, definitely we help them out with that. But in terms of debt management, that's a different focus. So that's one of the types of clients, I guess, that I wouldn't take on. It tends to be more decision driven, I would say. So, should I rent or buy? Should I, I've never invested before. How do I set up my investment portfolio? It really depends on what trigger is behind, them calling me. There's always something going on in their lives that triggers them to call me. They just had a kid. They want to figure out how to save through an RESP, for example. So those are the types of things that we help people with.
Okay, so the topic of education, the government is now trying to educate more people about money, and they've launched initiatives for that. What do you know about that?
I know a little bit. So the government set up a financial literacy task force a couple of years ago with a pretty broad panel. So there were representatives from the financial industry, from government, and there were a couple of journalists on there as well. So broad spectrum. So they set up this task force, and the mission or the purpose of this task force was to figure out ways to improve the knowledge, the skills, and the confidence of the average Canadian as it relates to money. And so I had the opportunity of presenting to them. They accepted a lot of presentations across the country, and they've distilled that down to a report that they produced recently, or earlier this year in 2011, on recommendations to improve the financial literacy of Canadians. And I think there may be some, there are some good recommendations in there. The question is, how quickly we'll move on them and how it'll get implemented. I know the federal government will be announcing a national financial literacy leader to take on the charge to implement these recommendations. So it's anybody's guess as to how quickly these things will get implemented. But I think a lot of advocates of investors or advocates of financial unbiased advice, I guess, like myself, felt that there were certain things that are lacking, and that is disclosure on fees that we talked about earlier. There's nothing in that report about disclosing the amount of fees that you pay on mutual funds. There was something about, in terms of a fund facts document. You might be familiar with this, Joe, for mutual funds, which is a simple document that the average person should be able to understand. So that's a step in the right direction. Or on credit cards, listing on the credit card statement how long it'll take.
How long it takes.
If you just paid the minimum payments, it'll take you 47 years to to pay off your credit card. So those are steps in the right direction, and I think these are minor tweaks. The other aspect of education is educating kids in schools. So whether it's elementary or secondary school. And that's, I think, a bit of a trickier thing because the federal government doesn't have jurisdiction over education. That's decided by the provinces. This is what I learned through going through the task force process. And so that's slower. That's been a slower adoption. BC has a program that I think is fairly good. Ontario will be implementing, some measures in the curriculum starting in September. Or already started in September of this year. But I think it does little. Like I wonder, the time will tell, I guess, with these things. My suspicion is that it's not doing enough in terms of educating kids on the right things and also educating adults because kids, the way I look at it is for most kids it's hypothetical. Like you're learning about credit cards, you're learning about tax returns, you're learning about investments, it's hypothetical. Once you get into your 20s and 30s, then it becomes more real. You have your first job, you have a kid, you have to save for their education, you might have to save for your own education or for your retirement, then it's more real. So the type of information and the type of advice is more, I suppose, urgent at that point. So broadly, I think we're making some strides in terms of education. I think there's a lot more that we can do to improve financial capabilities.
Yeah, time will tell.
Yeah.
So, in terms of your client base, how would you describe your client base? Who's the type of person you'd see the most? I know you mentioned people that were in their 30s and people starting to. Is there any certain segment of the population or people in certain careers or anything like that? that would come to you?
Yeah, what I've found is that I find that our service resonates really well with the 30-something segment of the market, which we talked about briefly, and also with women in particular. So, we didn't specifically target 30-something women when I started my venture. I just found that the type of counsel or the type of advice that we're offering through the consultations resonated well with that segment. Probably for a few reasons. One is when you're in your 30s, you're going through a lot of important financial decisions. So, perhaps buying a house, saving for your retirement, saving for kids' education, redesigning your investment portfolio perhaps, or becoming more tax efficient with your investment portfolio, supporting maybe parents that are starting to get older. So there are a lot of financial decisions that are coming at these 30-somethings one after another, and they're not equipped to deal with it because, like we talked about, they don't get educated in schools, they don't learn about it in university or growing up in the household. So all of a sudden, they have to make these decisions in their 30s, and they're saying, I need help. Am I making the right choice or not? So I think that's why we resonate with the 30-somethings. With women in particular, there's been talk in the media, and there's been articles recently that women are increasingly becoming breadwinners in families. They're taking control of finances. People are getting married later in life, and so you may have one or two jobs, you may have bought a house, you may have already started saving for your own retirement before you get married. So a lot of those decisions are being made by single people, and as a result, more and more women are becoming more interested in their finances. So as far as, I guess, who my client is, it tends to be 30-somethings. It tends to be more focused on women. I would say 75–80% are women. I get a combination of people that are single as well as married, married with either a kid or not. But that tends to be kind of the focus of my client base, and I think the service, like I was saying, that we offer resonates with that client base.
So do you find, well, I've read this in a few places, but do you find that like the traditional advisor, you'll go in there and they'll give you a bunch of charts,
yep,
pie charts, bar charts, and say the return is 10% versus 8 or 9 or 3, or so you should buy that, or the risk is 30% versus 20, or but I found, well, a lot of people are saying that that's not the whole picture, that's just some of it. Yeah. And a lot of people they make decisions with their mind or with their feel. Yep. This feels good, so I'll do it. Yep. Or this sounds good, so I'll do it, but the numbers are just either backing it up or a small section of the decision.
Yeah, yeah.
And I'm hearing more and more of that. Is that something you're finding as well?
Yeah, I think so. I think there's a few things in there. I think one of the interesting things, you're probably right in terms of if you go into your bank, you'll get thrown a bunch of charts that say, this fund has performed well, or this is the historical return of this particular asset class of stocks or bonds, or small cap stocks, or Europe stocks, or what have you. So I think that one of the things that you see this disclaimer a lot, past performance is not an indicator of future performance, because we can't predict the future. But a lot of people look at past performance to say, okay, it seems to be going up, and therefore I should be buying, more of this. Gold is going up, so I should buy more gold. It doesn't necessarily make sense for you from an investment portfolio standpoint. So that's one thing. I think the second thing is that I read an article actually just recently about how graphs and charts can be manipulated so that it shows the result that the person desires. So one of the most interesting things I think with showing investment returns is the time that you choose, the actual time horizon, or not time horizon, but the window of time that you choose for a particular investment. If you were to show 3-year returns, somebody's written an article about this, if you were to show 3-year returns, we're in December 2011, going back to December 2008. So if you invested $10,000 in December 2008, what would it be worth today, based on the markets, you would have done phenomenally well because you missed, the cratering of September, October, November
2008.
of 2008.
Yeah.
And so the time bias becomes so important in that chart. So it's important to question, what it is that you're looking at. The other thing is skewing. So, if a scale goes from 0 to 20,000 to show the Dow Jones average or the TSX, it's not going to appear that volatile because the scale is so large. But if the scale went from 10,000 to 12,000 or 13,000, then you're going to see that. You're going to see a lot more up and down. So the point is to be really leery of what charts are showing you. And how much does it really matter in terms of having a strategy for yourself, in terms of being responsible with investing? Warren Buffett, I like to quote him fairly often. One of the things that he said is that it makes sense to buy stocks on sale. So when stocks are going down, or when any particular investment product is going down, maybe it's a better investment than if it was going up because you're buying it at a bargain. So that's part of the part of that whole thing about charts and timing and having a strategy and all those kinds of things. So I guess in general, for most people, it doesn't make sense to try to time the market, so buying and selling at specific times. I think it makes sense to have a long-term strategy for buying the right investments, the right asset allocation, and holding it for a period that is 10, 15, 20 years, depending on what your goals are. It's kind of a long-winded answer to what you asked me, but kind of touching on different topics there.
It covers a lot of ground, yeah. So I guess related to that, do you find people say, well, the charts is a good example because if you start it right after a crash, the numbers look good.
Right.
If you start it before the crash, they look bad.
Yep.
And I remember I used to do these charts, so I know all of the tricks for that.
Right. Yeah.
And all that stuff came up. But people also looked at, I guess, how they felt about it. So if something is a fad, like now everyone's talking about dividends now. So if you pull out a dividend fund and say buy that, most people will buy it because that's the thing to buy. Versus say something that doesn't have any dividends, they'll say, well, some will buy it, but not that many.
Right.
And so there's this, I guess there's a psychology that goes with it.
Yeah, I
with
think
all the decision making.
I think that psychology is a very, very important aspect of money, of investing and of money in general. So, for example, with investments, there's a lot of stuff written about behavioral finance and how behavior affects what we do with our investments, and not only affects the individual investor, but also in fact affects the advisors themselves. So if you had taken a poll of advisors, there's research on this. If you'd taken a poll of advisors when a certain asset class was doing well, if stocks were doing well, then they would recommend that you continue to buy more stocks, even though perhaps it was time for a downturn in the market. And that's just simply related to the momentum of something's doing well, so it must do well in the future. Just like with housing in the United States in the years past, in 2004, 2005, the housing prices were going up and up and up and up. And the only way that it could go, based on that feeling or psychology, is that it would just continue to go up and up and up. So behavior has a huge impact, I think, on what decisions that we make. And I think getting a third-party opinion that is unbiased helps with questioning some of those behaviors or those decisions, like dividend stocks, for example. Does it make sense to invest a significant portion of my portfolio in dividend stocks? Well, maybe it doesn't, because your time horizon is 20 years, and over 20-year period the market will do fine. But if you're someone who is nearing retirement, who needs to draw an income off your capital, then maybe it makes sense to focus on dividend paying stocks, for example. So I think that the psychology of money, or the behavioral aspect, is an important thing, that getting that third-party opinion, like I was saying, getting that unbiased opinion is helpful in terms of resetting your expectations in terms of money and in terms of investing.
Yeah, I could say from, just following what's been happening the last 10 years, 20 years, the emotional aspect is being stirred up all the time because of all the news.
Yes, yes.
And people that used to stick with things are not.
Yep.
Because, this is falling apart, I gotta get out, that's falling apart, I gotta get out, that. And then it becomes, I don't know what to do now.
Yep.
And in the past, there wasn't as much of it. It was more, there was 10 years between crises. Now it's a couple of weeks, a couple of days,
absolutely,
a few hours.
I think that's a really good point. Before our lifetimes, people would actually pick up the phone, probably a rotary dial phone, and call their broker and say, I would like to buy 100 shares of General Electric. And your broker might say, are you sure you want to do that? They might actually question you before you do that. But now you can simply go to your discount brokerage and punch in 100 shares of GE and buy it without question. And so simply giving a reason for that decision as to why you want to buy it, I think has a significant impact. If someone says to me, I need to buy, this investment product, gold or dividends or dividend paying stocks, why do you want to buy dividend paying stocks? That simple question, like getting people to articulate why it is that they want to do something, even buying a home, why do you want to buy a home? I think helps in terms of, understanding, what is actually the trigger behind people wanting to do something, whether it's buying an investment or buying a home. So you're absolutely right, I think, in terms of we're able to get information from so many sources now, and from global sources, that it affects our psychology, and therefore it can affect our decision making in terms of being impulsive with investments, because we have the tools. We can go right onto our smartphone and trade right away if we want to. And so I think the risk is greater that we're going to make a wrong decision and regret it. And so going back, 20, 30, 50 years, people would buy investments and hold them for the very long term, and not look at what the stock is doing every day as we can do now. So it's a bit tough, I think, for investors in that sense, to be able to shut out that noise and just have a strategy and not worry about what is going on. Like we talked about before, there have been crises in the past, and if you don't pay too much attention to it, then I think you will do fine over the long term. So.
And that applies to everything, like debt. I was thinking about in the past, it was cash, checks. Everything took a week to clear.
Absolutely.
Everything took long. To buy that stock took half a day.
Maybe that was a good thing.
And in a way it was, but like that GE would take 3 hours to buy.
Right.
Because it'd be relayed from one person to another
right.
via paper. Onto the floor, and then paper would come back.
Get the physical share certificate saying you have 100 shares.
And so you'd have to think about everything. Do I really want to do that? Do I really want to do that? Because you're waiting for them to fill it. And by the time you're waiting for them to fill it, they might say, well, maybe I don't want that. And you might actually not do half the decisions. And with debt, I've seen that because it's so easy to spend, it's spent. Before it was hard to spend. You had to bring the cash, you had to bring the checkbook, and you had to balance everything out, and even just the time to write out the check would give your mind time to say, wait a minute.
Do I really want to sign this?
That's $20,000 on that check, wait a minute.
Right.
And people would actually take it home and think about it.
Yeah, we've become
and
very, I think, very credit hungry or credit focused as consumers as well as the financial industry. So the financial industry profits from issuing credit, whether in the form of credit cards or lines of credit or mortgages, and they would like you to take as much credit as you can and take as long as you can to pay it off, so that they can make the most interest. And that is a sea change from decades past, I think, in terms of the psychology of I can buy now and pay later and worry about it later, have my enjoyment now. And I'm not advocating that put off everything until later. I think we should. You can have everything, but you need to prioritize what you have when, so that you're not caught in a cycle of debt. And Mark Carney, the governor of Bank of Canada, was on the CBC this morning talking about how Canadian households are continuing to take on more and more debt, and as a percentage of household income, we're at nearly 151%. So that means for every $1,000 of income, you're actually taking on $1,510 in debt. So that includes credit cards, mortgages, loans, lines of credit, etc. So right now it's okay because interest rates are low, but at some point in the future, we don't know when, as interest rates rise, that's going to put a squeeze on people that have been living on the edge in terms of those debt numbers. So it is certainly a concern that if you have a lot of debt, I think it's something that you would be concerned about.
So we have a few minutes left.
Yeah.
If you'd like to tell people how to contact you, and a website, an email, and
sure. Yeah, so the best way would be if you go on to the website, so it's moneylifeskills.com with an S at the end. So that has all of the contact information, email, phone. We also introduced a live chat option, so chat with a financial consultant live. So that's something that if people don't feel so comfortable with at work, picking up the phone and calling us or emailing us, they can have a little private chat with us. The phone number is 647-727-7121. So those are different ways that people can get a hold of us. So as far as the website, it's fairly informational. It talks about the service that we offer, the fees that we charge. And there's information about articles that I've written, the one that we talked about earlier, as well as some interviews that we've done with the media as well. So people can get an idea of what our philosophy is and what our focus is in terms of the services that we offer.
Yeah, it's very good.
Great.
So thanks for coming out.
Yeah, it was a pleasure. Thanks for having me on, Joe.
So that's our show for today. This show is called The Cube Talk Show, and it's about money, and it airs every third Tuesday of the month. Next week this show will be playing again, and which is not usual, but that's why I said that now. And if you want to see any past episodes, you can go to thatchannel.com in the past shows tab, and you can find my banner up there, the Cube Talk Show banner, and also on my website, www.joetheinvestor.ca. And my contact information is joetheinvestor.today@gmail.com. And that's it for tonight. Thanks for watching. Have a good evening.
This is a piece where I've taken a snippet from the Bach cello suite, and I've looped it, and I'm playing sitar over it. As you can tell, I like to mix cultures from around the world. We got didgeridoo from Australia, sitar from India, and Bach from Western Europe. So this is just a mellow little tune. It's based on the cello suite, and just sit back, relax, and enjoy. It's a hippie town. They have music, pretty much live music, 300 days of the year. They have huge festivals. Great artists from all over the world go there, and it's a place where you can meet